Imagine waking up one morning, reaching for your phone, and seeing money sitting in your account. You didn't sell anything, you didn't work a single hour, you didn't lift a finger. The companies you own simply paid you. And then a few months later, they pay you again and again. Money that shows up whether you're at work, on vacation, or fast asleep. This is the dream that pulls millions of people toward dividend investing, getting paid just for owning a piece of a business. It sounds almost too good to be true. And here's the uncomfortable part. For a lot of beginners, it kind of is, because hiding behind those juicy dividend payments is a trap. A trap that looks like free money, but quietly costs people thousands of dollars every single year. So before you go chasing the highest yield you can find, let's break down exactly how dividends really work, where the magic is real, where the illusion hides, and how a complete beginner can actually build income the smart way. Welcome to Jecob Finance, where we break down investing in a simple way. But first, a quick disclaimer, this is not financial advice. Now let's get into it. Let's start with the most basic question. What actually is a dividend? Picture a small pizza shop. You and a few friends own it together. At the end of the year, the shop has made a nice profit. Now the owners have a choice. They can take that profit and reinvest it, buy a second oven, open a new location, hire more staff, or they can split the cash and hand each owner their share. That second option, that slice of profit paid out to owners, is exactly what a dividend is. When you own a share of a company that pays dividends, you're one of those owners. And a few times a year, usually every 3 months, the company sends you your cut of the profits in cold hard cash. Now let's make it real with numbers. Say a company's stock costs $100 and it pays $4 per share per year in dividends. If you own 100 shares, that's $400 a year landing in your account just for holding the stock. That $4 divided by the $100 price gives you what's called the dividend yield. In this case, 4%. Yield is simply how much income you get each year compared to the price you paid. Keep that word in mind because in a few minutes, yield is going to be the exact thing that traps most beginners. But first, let's talk about where dividends get genuinely powerful. It's not the payment itself, it's what you do with it. Meet two investors. The first, let's call him Spender Sam. Every time Sam gets a dividend, he takes the cash and spends it. Nice dinners, small treats, a little extra fun money. Nothing wrong with that. The second investor is reinvestor Rachel. Every time Rachel gets a dividend, she uses that cash to automatically buy more shares of the same company. This is called a DRIP, a dividend reinvestment plan. Now here's what happens over time. Rachel's extra shares start producing their own dividends. Those new dividends buy even more shares, which produce even more dividends. It's a snowball. Her income grows on top of itself, faster and faster, without her adding a single new dollar. In fact, over long stretches of history, a huge share of the stock market's total return hasn't come from prices going up at all. It's come from dividends being reinvested, quietly compounding in the background, decade after decade. Same companies, same money invested. The only difference between Sam and Rachel was one choice: reinvest or don't. So dividends are free money, right? This is exactly where I need to stop you. Because here's the catch almost nobody explains to beginners. When a company pays you a dividend, its stock price drops by roughly that same amount. Think about it. If a business hands out cash from its bank account, that business is now worth slightly less. So on the day the dividend is paid, the share price adjusts down. That means a dividend isn't magic wealth appearing from nowhere. In a sense, it's the company handing you back a piece of your own investment. This one fact changes everything about how you should think about dividends. A dividend is not a bonus on top of your investment. It's a decision about where your money sits, in the stock or in your pocket. And once you understand that, you become almost immune to the single most common mistake in dividend investing, the yield trap. Let me introduce one more character. High yield Harry. Harry is scrolling through stocks and he spots one paying a 12% yield. 12%. He can't believe it. He thinks, why would anyone settle for a boring 4% when this exists? So he pours his savings into it. But Harry never stopped to ask the most important question. Why is that yield so high? Remember, yield is the dividend divided by the price. There are two ways a yield gets huge. Either the company is paying out an unusually large amount, or the stock price has already crashed. And a crashing price is usually the market screaming that something is wrong. A high yield is often not a reward, it's a warning light. And it gets worse. When a struggling company can no longer afford its dividend, it does the one thing dividend investors fear most. It cuts the dividend. The income Harry was counting on shrinks or disappears, and the stock price usually falls even further on the news. Harry loses twice. That's the yield trap. Chasing the biggest number instead of asking whether it's actually sustainable. So how do the smart investors avoid it? They stop looking at yield alone, and they start looking at quality. One quick tool for this is the payout ratio, the percentage of a company's profit that it's paying out as dividends. If a company earns $1 and pays out 90 cents, there's almost nothing left to survive a bad year. But if it pays out, say, 40 or 50 cents, the dividend Dividend has room to breathe and room to grow. And growth is the real secret. There's a group of companies known as dividend aristocrats, businesses that have raised their dividend every single year for decades through recessions, crashes, and crises. A steady 4% yield that increases every year will quietly crush a flashy 12% yield that gets cut. In dividend investing, boring and reliable almost always beats exciting and fragile. Now you might be thinking, this is a lot of researching individual companies. And you're right. So here's the beginner-friendly shortcut: dividend ETFs. Instead of trying to handpick winners and dodge every yield trap yourself, a dividend ETF bundles dozens or even hundreds of dividend-paying companies into a single investment. If one company cuts its dividend, it barely dents the whole basket. You get income and instant diversification without needing to become a full-time stock analyst. For most beginners, a broad, high-quality dividend ETF is a far safer starting point than betting everything on one exciting stock. But before you go all in, let's be honest about who dividend investing is actually for. If you're older, closer to retirement, or you simply love the psychological boost of seeing real cash arrive, dividends can be fantastic. That steady income keeps a lot of people calm and invested when markets get scary. But if you're young and decades away from needing the money, chasing dividends isn't always the best path. Fast-growing companies often pay little or no dividend on purpose. They reinvest every dollar back into growing the business, and that can lead to bigger total returns over time. There's also a tax angle. In a regular account, dividends are often taxable in the year you receive them, even if you reinvest every cent. So where you hold these investments actually matters. So what's the real takeaway from all of this? Dividends are one of the most powerful tools in investing, but only when you respect how they actually work. They're not free money, they're your money being handed back to you. The highest yield is almost never the best yield. Quality, sustainability, and consistent growth beat flashy numbers every single time. And the real magic isn't the payment, it's reinvesting it over and over and giving it years to compound. Get those few ideas right, and dividends can slowly turn a simple portfolio into a machine that pays you for the rest of your life. If you found this helpful, let me know down in the comments. And if you want more videos breaking investing down in plain, simple language, make sure to subscribe. Thanks for watching, and I'll see you in the next one.